In yesterday's video, we talked about how, yes, we had heard from the Fed, but we had also heard from Kashkari, and he was the most dovish member. And we needed to hear from the other members that were going to speak today, particularly Mester. We also said Bullard was going to speak. My correction, he did not speak today as far as I'm aware. We got Daly and Evans, but Mester, big one. She talks on CNBC a lot. She's done interviews at CNBC. That's what I watched during the day. And she seemed to move the market a little bit, as we talked about yesterday. She has moved the market in the past several months, and she did so again. We're not changing our strategy over here, though. We are long. We are taking a little bit of margin to get a little bit of the juice. And we're also hedged up against rates going up. I thought yesterday and the past couple of days were a good time to do that. Rates were rather low. I still think they're rather low compared to where they can go. You know, we had quite a lot of tension. We had a lot of people saying peak inflation, pricing in rate cuts, et cetera, et cetera, et cetera. It's kind of the perfect storm for rates to be low. And it might be a little premature to call for peak rates, to call for Fed cuts. Doesn't seem like Fed cuts are going to happen in January. They're not really giving us any guidance on where they're going to go beyond 3% or 3.5%, or if they're even going to do that. What they are giving us guidance on, though, is that they're going to keep rates above neutral, their definition of neutral, for some time. That their rate cuts are not on the horizon. We're in a recession, and they're not talking about rate cuts. So we should get rid of that notion of rate cuts. They want to see some slowdown, and we're going to get some slowdown, and that's going to happen, and we're going to let that fester out. So with that, do we get rid of all tech? Do we go short? Do we bet on a decline? Do we bet on rates rising and taking everything down, just like a simple machine mechanism? I'm not. You're welcome to do that, but I'm not doing that. And here's why. In past videos, you know, we were long this rally in the early stages. And one of the reasons we cited was the fact that ARK had bottomed, but the S&P 500 hadn't bottomed. The S&P 500's bottom correlated more closely with yields peaking, but ARK, they didn't bottom when yields bottom. So I'm not afraid of yields getting back up to 3.5%. I think stocks are going to be impacted by that. They're going to take some sort of hit, and we're going to talk about how we avoid that and not worry about that so much in a second. But ARK weathered the storm of 3.5% yields. It weathered the storm of the S&P 500 bottom, 3,600, whatever, and change. So I think there are areas of the market that are flushed out. And there are stocks that are cheap in those areas of the market. There are U.S. companies and there are foreign companies. Yesterday we talked about StoneCo. Uber is now my third largest position. So there's things you can buy. There's companies that are resilient. Uber closed near the highs today, despite Mester. There are stocks up after hours, despite Mester. PayPal offered, or is going to execute on, rather, a $15 billion share buyback despite Mester. Apple bought back a tremendous amount of stock despite 3.5%. They also just borrowed some more money to buy back even more stock and to pay dividends. So, yes, we think rates are going to go back up. I don't know exactly where they're going to land. That's not what I'm betting on. What I'm betting on is the Fed funds rate and the 10-year and the 20-year being way too close. There should be a little bit of a cushion between that. So I'm betting that that cushion is going to grow, the Fed funds rate's going to go up, and the cushion is going to have to levitate a bit. That's all. That's all. And once I feel like that's getting a little bit extreme, we've seen a gain there, we're going to start to pare that back. That's going to be my protection. That protection is going to allow me to buy companies like Uber at tremendous prices, like StoneCo at tremendous prices, like Jumia at tremendous prices. What's the theme here? The theme here is protect against the big event that you can't control. The rates rising, right? Have some exposure to that. Don't go 100% stocks because it's uncertain out there. It's not easy right now. And you want to, when things don't go your way, don't go the long's way, be able to see some green get some cushion in there, and when that gets too extreme, to sell it and to have some cash and to, dollar cost average in that one shot or several other shots and have some protection. So I feel very good about that setup. And I'm doing my homework on these individual companies, buying individually strong names. I know I'm not going to buy the very bottom tick. The guy who does that, I know is lucky. How many times have you bought the very, very spec bottom and sold the very, very spec top? Maybe you've done it once or twice, maybe 3-4 times. We do a lot of trades. What percent of your trades are that? Do you always hit the very bottom and do you always sell the very top? I don't think so, okay? I don't think so. If you're smart, you buy on the way down, nibble on the way down. And if you're smart, you sell once you think things are starting getting toppy and you start slowly selling. That's just the way it is. I've got some stocks. I realized I didn't buy them at the very low. I bought them at good prices, mostly. And if I didn't buy them at good prices, I bought them as they continue to fall, is what it is. And I like these stocks. I know the next couple months are uncertain. But I also know a company like Uber can pop 10% after hours. And I can feel comfortable in it because it's producing cash flow. It is. I get it. They had some investment-related losses. If you take those out, they had cash flow. This is a company that is focused on profitability. I'm buying growth companies that are focused on profitability, not Apple, not Amazon, not mega cap, not 5, 10, 15% growth. I want 100% growth. There are companies in that 100% seeking growth category that are close to profitability, focusing on profitability, and are 60, 70, 80, 90% off their highs. I'm comfortable holding those. I get it, rates are going to go up, but I'm also playing rates possibly going up. So with that mix, sure, I'm going to have some fluctuation. There's going to be some volatility. Maybe things stall out, but I'm light on the options right now. I don't need to make money this second. I can't get burned like that. That happened last week. Learned a lesson there. And we're just going to be patient. We're going to ride this out. Fine, rates go up. We've got positions that will make some money. We'll sell those positions. We'll get out of that. We'll have some cash. We'll deploy it back into new longs or add to existing longs. And we'll coast. We're going to coast. We're going to keep going forward. We get it. Prices are going to fluctuate. But at the end of the day, we're not going to worry about one price. We're not going to worry about one piece of news unless we have to. We're going to worry about the businesses that we're investing in themselves. We're going to focus on that. If we focus on that and we focus on rates, I think we can be comfortable and confident going forward. So that's today's video. And until next time, peace out.